In this module, we're going to look at, or this video, we're going to look at step number 4. And step number 4 is typically when some things start to break down, simply because now we're talking about adjusting entries. One of the reasons why I put so much emphasis on cash versus accrual systems is that one thing to note about adjusting entries is that they are part of an accrual system. And we need these, absolutely need these, in order to make an accrual system work. And so we need to pay very close attention to what adjusting entries are doing. And you really have to have that logic of an accrual system behind you in order to really understand it, intuit, and peel back the layers of memorization to get to the core understanding that these make perfect logical sense in a system that does not necessarily record revenue and expenses with the simple exchange of cash. So adjusting are made at the end of an accounting period to bring all the accounts up to date so that financial statements can be prepared. The idea being that unless we have these adjustments made under an accrual system, we are missing key revenues and expenses that have not yet been recorded. So what adjusting entries are applications of revenue recognition and matching principles, hence why I put so much emphasis on those in Module 1. The adjusting entries recognize expenses and revenues that would have otherwise not been recorded during the period because, and this is implied but not stated, if cash had been exchanged and we had recognized the revenue or the expense with the exchange of cash, it would have been recorded during the period, because if we received cash, we debit it. Well, what are we going to credit? We perhaps credit that revenue. If we spent cash, we credit it. Then what are we going to debit? Well, probably in some cases an expense. So the revenues and expenses that would not have been recorded were non-cash transactions. And so adjusting entries record non-cash transactions at the end of the period, recognizing revenues and expenses that would have otherwise not been recorded. So let's look at this on a timeline. For a firm with a fiscal year end of December 31st, we would adjust our accounts at the end of the period for any activities that occurred from the beginning of the year all the way to the end of the year. So any of the items that did not have a cash flow, but activities that still generate a revenue or expense. So again, we have non-cash transactions, non-cash revenues, and expenses resulting from transactions that occurred. Now, at the end of, or if we could, this is a full year. Now, this is assuming if we're going to make all of these things at the end of the year, all these adjusting entries at the end of the year for things that happened during the year, then we're assuming no adjustments have been made on a monthly or quarterly basis. So some companies might stop at the end of every quarter and make their adjusting entries on 3/31. And if they did that, then they would just be making adjustments for activities during the three months that happened, January, February, March. And then they would do that again up into April, May, June, all the way to June 30th. For the second quarter, they would make another adjusting entry for the second quarter. Then they would do that again for up to September 30th for the third quarter. and then they would make a final set of adjustments at the end of the fourth quarter. So it doesn't matter when you make the adjustments. All it has to be is a period that for which you want to report. You could break it up into as many small pieces as you want. It could be every month. It could be every week. You're starting to overcomplicate perhaps the smaller you get, but it is just, and remember, by the periodicity assumption, it's fine the reporting period whenever you want to, because whenever you end it, if it's at the end of the week, that reporting period, the adjustments made during the week perfectly encapsulate those 7 days. Those adjusting entries made during the month just perfectly encapsulate those 30 or 31 days, right? So it's arbitrary. However, in the class setting, unless otherwise stated, then you should assume that we're talking about fiscal year end December 31st companies. So we're always going to be thinking about the year end of a company happening on December 31st. We're also going to assume that with that year end, no adjustments have been made at any point during that year. So we don't have any quarterly adjustments. We're just going to have one big batch of adjustments that cover all these non-cash revenues and expenses that have not yet been recorded, and we're going to record them all at that end date, 12/31. And you have your key takeaway here. Adjusting entries are necessary to make accrual system work. They represent items that are recognition of expenses and revenues without cash. Remember, the revenue recognition and the matching principle are the two items that drive our record of adjusting entries in step 4. So what are the rules that derive from this? The rules of adjusting entries. One rule is very big. We've already covered it, but just so you know, cash is absolutely never ever a part of an adjusting entry. The whole point of these is to recognize non-cash revenues and expenses over a period of time. The second one might not follow quite as readily to you. Every adjusting entry always affects one real account and one nominal account. So I wrote backwards. Let's talk about the nominal account first. So it has to have at least one nominal account. We have to recognize a revenue, an expense, a gain, or a loss. Always one of those, not two, not three of them, but just one will be recognized by an adjusting entry. And remember that the reason why we're applying adjusting entries is to recognize non-cash revenues, expenses, and we can also take this to mean, well, gains are going to be recorded as long as they are not a part of the central and ongoing operations. Expenses or losses. Losses could be recorded as easily as expenses, again, as long as they are not part of the ongoing major central operations of the business. But otherwise, they are also items that can occur in an adjusting entry. The whole point of an adjusting entry is to recognize a revenue, expense, a gain, or a loss. Therefore, this is always going to happen. At least one of those items is going to be adjusted for. We'll come back to the bullet point in a moment. Now, if we're recognizing a revenue, expense, a gain, or loss, remember, go back to those definitions. And again, this is why I really harped on the idea of revenues, expenses, gains, and losses and how they're defined. Remember, we'll take one of them and then you can work through the others on your own. But if we think about a revenue, remember, a revenue is an increase in assets or a decrease in liabilities that result from the central or ongoing operations of the company. So anytime we record a revenue, there's always an effect to assets or liabilities. Having a revenue is sufficient to say something happened to an asset or something happened to a liability, just by definition. So expenses are the same. We just reverse the signs. Expenses are decreases in assets, increases in liabilities. Remember, gains and losses, the same definition is an increase in assets or a decrease in liabilities. The only difference between a gain and a revenue is whether it fits in the company's core operations. So If we are going to have a nominal account, then we absolutely have to have one real account, an asset, a liability, or a contra or adjunct account. We just studied those in step number 2 that are tied to assets and liabilities. So it doesn't have to be a pure asset or a pure liability. It could be a contra asset or a contra liability. In the case of assets, common examples that we adjust in an adjusting entry: accumulated depreciation, prepaid assets, interest receivable. Those are just some off the top of my head. In the case of liabilities, our common examples are payable accounts and unearned revenue accounts. For the bullet under a nominal account, there is a sort of intuitive stance where we have, if we're adjusting, for example, a prepaid rent contract, prepaid rent would result in rent expense over time as we are using up the prepaid rent contract, and the credit is to prepaid rent. So there becomes a pattern with what the item is tied to on the debit and the credit. So basically, for any prepaid contract, we could just substitute a different word in for rent. We could talk about insurance expense and prepaid insurance, right? We could talk about utilities expense and prepaid utilities. So it becomes more about we're debiting an expense and we're crediting a prepaid. Okay? You're going to notice that logic a lot amongst the adjusting entries, and so it gives you another way of remembering things and connecting ideas without feeling like you memorize 15 different, completely different transactions. Another example in terms of expenses is sometimes we accrue liabilities through expense. So like we might have interest expense and interest payable when we have interest that's accruing over time, but we're not paying off. You could substitute a lot of things in for interest. One of them might be wage expense and wages payable. Maybe it's a bill you didn't pay rather than a bill you prepaid, utility expense, utilities payable. And notice too that all of these satisfy our definition of, or our rules for adjusting entries. There is one net income item and there is one non-real account. In the case here, we got liabilities with interest payable and we got assets with prepaid rent. There are 2 types of adjusting entries. Broadly speaking, we have adjusting entries that are accruals and adjusting entries that are deferrals, sometimes called prepayments. And it all has to do when cash is received. For accruals, revenues and expenses predate the cash, before cash. So with accruals, the recognition element, the recognition of the expense or the revenue happened in cash, paid or received. Paid in the case of the expense, received in the case of the revenue. When we have the deferral, we have the opposite situation of cash being paid in advance or cash being received in advance. And then at a future date, the recognition part happens. We recognize, in the case of payment, we'll recognize the expense at a later date and time. We'll recognize the revenue at a later date and time in the case of receiving cash. For example, up here, interest expense, interest payable. Well, if we're recording a payable, that means we're paying in the future, but we're recording the expense now. So if you look at it in the realm of accruals and deferrals, interest expense is a type of accrual. We're recognizing interest expense now. We're recording a payable with the interest expense because in the future we're actually going to pay it off. In the case of rent expense and prepaid rent, well, the cash was paid up front. It was paid up front establishing the prepaid rent account, And then in the future, we're recognizing rent expense and decreasing the prepaid rent asset. So it's a deferral or a prepayment because the cash was already paid. All right, we'll stop there, pick up on some actual calculations and journalizing these items.